Hi guys, so we're looking at Begbies Treynor Group. It's an insolvency type company, which I had an interest in 2016, but didn't invest because I was purchasing a house. But I did have a conversation with people on Twitter. Didn't do anything, but now we're going to look into it because it feels to me like corporate insolvencies are going to go up. So the sides of the business they have, let's move me. They've got an insolvency side, and they've actually got an advisory and transactional services side of things as well, which offers things like financial advice, funding options, valuations, transaction support, property and projects and development. And they've got a really interesting mix, actually. 60% comes from insolvency and 40% from other services. The revenue has increased 11%, profit 16%. Looks like profit is around 18% margin, which is good, something like that. EPS is 10p, which is very good when you look at it from a PE ratio. Although it is less than, it looks like it's slightly less than earnings. So I wonder if the share count goes up every year. I'm not sure. There's a dividend, which is up nearly 10%, and they've got good free cash flow, and they've got good net cash. Let's look at the finances. Look at this, revenue's gone from 60 million to nearly 90 million in a very, very short amount of time. And it looks both sides of the business have grown. Profits have gone from 14 million to 24 million. That's like amazing. So it looks like everything's going well. Revenue's increased, margins have increased to 26%, which is pretty good. Insolvency revenue has gone up to 70 million. Advisory revenue has jumped massively from 4 million to 19 million. And the headcount's gone up as well following a Mantra acquisition. I think that must be an advisory company potentially. So it looks like they're expanding because in 2016, I don't think I can remember them having much advisory. Let's keep going. Look at this, revenue's increased for property from 24 to 32 million. Looks like they're offering an end-to-end service where companies can talk to them about auctions and selling property, valuations of property, and they're growing through acquisition and organic growth. Here's the valuations part of it. And they've got asset management and also insurance as well. Commercial property management is another side of things. They've increased headcount through acquisitions. This makes a lot of sense. There's going to be a lot of companies, whether they're going through insolvency administration or approaching that are going to need valuations of their properties. So this kind of makes it more vertically integrated. Whoops. EBITDA's up pretty healthy, about 10%, something like that. Working capital's down a little bit. Cash has gone up, which is good. Free cash flow is up a small percentage. Dividend was up. Some earnouts because they're bought companies. Free cash flow is down a little bit, but that's because they're bought companies, which is where you can see this acquisition payments. Share issue. So it looks like they are expanding their share base, which is what I thought that was happening. Nevertheless, they've got some liquidity to do more acquisitions. They've got 25 million secured, which is good. And facilities have been extended to 2025, which is good news. They're probably locked in good rates for finance, and it looks to me like they're growing through acquisition pretty well. They're confident of the outlook. Insolvency is likely to do better in these markets. They bought this other company, Banks Longs. I don't know Banks Long. I'm not sure what that is, but generally cash is good, balance sheet is good. They've got room to acquire more companies. Analysts are reckoning 22 million, something like that, profit before tax, and they've added 20 million, so it's like 9x PE. For a company growing at this rate, I think that's very cheap. Let's keep going. Insolvency is on the rise. You know, in 1992, it's 30,000 corporate insolvencies. It seems like we're trending towards that. Administration appointments seem to be potentially that might trend up as well. Higher interest rate environment, cost of living, all this is going to squeeze out and cause a lot more insolvencies and problems. If we look at the size of the company, Begbies Treynor is pretty big. It's bigger in terms of corporate appointments than the big four national accountancy firms, although they may be skewed because they may have bigger sized contracts. But nevertheless, it looks to me like there's a lot of opportunity because the company has 13% market share. But if they can capture some of these local boutiques, which actually, would probably be quite cheap to acquire, the company could grow quite rapidly. They're not going to be able to buy out a big four. They're not going to be able to buy out national accountancy firms, I don't think. Therefore, American and local boutiques seem to be the opportunity area, and they could expand their corporate appointments materially by buying out other people, other firms. Look at this, everything's growing, which is good. In some cases, substantially. Less than or equal to 10K deal size has more than doubled. 10K to 50K has about doubled. Greater than 50K is less than doubled, but it's still growing substantially. And overall, it looks like revenue by case has about doubled from around 36 to 71, 72. So they're using some digital marketing. Obviously, that's the thing I do. They're getting a lot of referrals, which is good. And they've got some big administration projects, including Paperchase, which is a big retailer. If you guys have heard of these other firms, Avonside, Worcester Warriors sounds like it's a sports team. Cox & Cox I've not heard of. Let me know if you know anything about those in the comments below. This is where the advisory thing is coming about. Look, they've seen revenue rise from 25 million to 51 million. So a doubling of revenue in a very short amount of time. It's very good here. They're saying the acquisition in fragmented service areas, giving the ability to add scale and increase margins. So you can see there's a lot of different advisory services that they're getting here. It's pretty diversified. They've got funding, financial advice, valuations, support with transactions, and asset management. This is really interesting because it's vertically integrating the company, which means that even in a growth market, a company might be looking for financing or optionality with their development support and project management, etc. And if they ever get into problems, then indeed they might also be looking for help to value a project and insurance around that, or indeed helping to sell things as well. And here we go, look, integrated expertise. I've got debt collection, property valuation, insurance, forensic to investigate events leading to insolvency, so they can have some services to provide kind of prevention of insolvency, which I would imagine would be a very good service there as well. Complementary services, synergies or integrated or vertically integrated, however you want to describe it. All of these things benefit one another. Cross-selling against finance and financial services, funding, etc., property, corporate insolvencies and restructuring, M&A advice, etc. So they can grow organically through retention and recruitment of new talent and firms, etc. Investment in tech and better working practices, probably paid media probably factors in there, something that I specialize in, acquiring new customers from paid advertising. Also the acquisition strategy we talked about, value accretive acquisitions in the following market segments: insolvency, advisory and transactional services, and complementary professional services, continued development of the developing size and scale of the group. Let's look at this in terms of the efficacy of their acquisitions. You can see revenue growth has basically more than doubled from 60 to 122. Out of that, the acquisitions have contributed 38 of that 62. So it's more than half of the growth has come from acquisitions. So they're doing something right. And if we look on the right-hand side, how it splits, property is where they've really put most of their chips. You can see from the financial advice, just 3 segments throughout this year, whereas insolvency are 3, and the vast majority has been in property services. So that's something that's interesting. It seems to be working out quite well. So you'd assume that the revenue is split in a similar way, that maybe the property services is providing a lot of that revenue. They haven't broken that down there, but that might be interesting if they could break it down. I don't know if they do it later in the deck. Doesn't look like it, but overall, I love these kinds of slides. You can see revenue has ticked up nicely. doubled or more than doubled in the last 5 years. Well, obviously not at the end of 2023, so they must have a mid-year end of year, but nevertheless, adjusted profit before tax has nearly tripled in 5 years, which is fucking amazing. Excuse my language, but look at that, amazing. Dividend is up. Whoopsies, let's go back to that slide. Dividend is up. It's not quite doubled, but it's still pretty good. EPS has doubled as well. I think this suggests that the share count has gone up. The fact that EPS has not tripled, but profit has. Likewise, dividends haven't doubled or tripled. So it looks like they're expanding the share count. Maybe they're giving acquisitions more shares. Maybe the directors are taking out shares as well. So it's not particularly great for investors, but it's a growing company. I don't like when companies, pump out loads of shares, because it just reduces the net return for investors. But nevertheless, I'm sure the company's still done well. So they've got a platform, they've got finances to grow. These are the 3 sections: financial advisory, funding, and transactional support. Makes complete sense to me. Valuations, projects and development within property and otherwise, asset management, insurance, risk management in terms of vacant property. I think that's smart. So they've got a lot of smart services here, not just in insolvency. This is the analyst metrics. These are the pros. I'm not a pro. I just do this as a side thing for free out of interest. But what are they saying? They think there's going to be, from acquisitions, 4 million of revenue and just less than a year of profit. Adjusted tax rates 26%. They think there's going to be more shares. It looks like 160 million have diluted. It'd be interesting to see that in a 5-year. I'm not going to look at that in this deck though. Cash flow, blah, 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 blah. Small amount of capex considering how much money they make. They're making quite a lot of revenue and only 1 million in capex. So that's pretty good. They've got these consideration payments for the acquisitions. I guess that's Bank's Long acquisition, possibly, or some other acquisitions, maybe. This is the ownership structure. It's a small company, 200 million in valuation, but it's got quite a lot of major institutions. But first, let's look at the insiders. The insiders own about 19%, something like that, of the company, which is always good. Having a look at the ownership stake for the major institutions, I have met a few of these Marty Global Investors. I can't remember the guy's name, but he's very smart, mild-mannered, but a smart guy. And Slater, Mark Slater, I think is that chap's name. And they're very, very smart cookies. I've been following what they do on and off for the last few years, and it's good to see their names there. I don't know all of these guys just because I'm not in this space. I'm not a fund manager myself or anything like that. But it's interesting to note that, there's quite a lot of ownership here. I don't know what it is. It looks like it's over 25, 30% or plus, might be more than that, of institutional investment. That's good in a way that they're backing such a small company, but it could be bad if there's ever any price drops, profit warnings, risks, etc. Then the share price could decline because of having so much weighted towards major funds and whatnot. There is a slight risk there, but it is interesting that they own so much. I like it when owners, when funds don't own so much of the percentage of the shares, but I suppose they have a lot of faith in this company. Stop sharing my screen. I can see that the shares have done well. I didn't buy them because I was buying property, but I was right to be interested in them in 2016. They've done well since then. And now I think it's an interesting time for them. I think the corporate insolvencies are going to rise, as well as individual insolvencies. I know buy-to-let landlords are going to be at risk. It's something I warned about or thought could happen in late 2021. Landlords to fix their buy-to-let mortgages. I don't know how many people will even watch that video. Nevertheless, I think buy-to-let landlords are going to suffer. And I think there's going to be a lot of corporate insolvencies and restructures and M&A activity in the next few years because the cost of living and disposable income, share of disposable income in the wallet of the average individual, whether you're a family, a young adult, or even a pensioner or an investor and buy-to-let investor with mortgages, I think that disposable income is going to disintegrate for most people. So that's going to cause a squeeze on corporate profits, especially consumer-focused profits. I think most companies are going to suffer. So in summary, will these guys do well? I think they will. They've got a dividend. It's not a huge dividend, but the equity growth of the companies is phenomenal. They're quite well positioned to grow and acquire good prospects to help them grow. And I think their plan to kind of land and expand in terms of professional services that they're going to offer by bolting on these acquisitions is a smart strategy. There's a slight risk they might diversify by going too broad, but they seem to know what they're doing with these acquisitions. As you saw, most of the growth in the last few years has come from these acquisitions, so that's a good sign. I like it. I think it's interesting. Let me know what you guys think. Are you an investor in this company? Would you consider investing? What do you think about my analysis? I've only looked at this once before, which was last night when I forgot to share my screen. So I've redone it today on the 12th of July. I really think this is going to continue to do well. I'm kicking myself a little bit that I didn't invest in 2016. Later on, I think it was 2018 or 19, I don't remember when Catebox launched, but I invested quite a bit in Catebox. It's interesting, this is a kind of a boring company, this Begbies, but I think it will do well. It's valued at 200 million. I wouldn't be surprised if it doubles or triples in the next 5 years again. Who knows? Let me know what you guys think in the comments section below. Remember that I make videos on listed equities as well as angel investing and property. I make the occasional prediction. Some of the things I've predicted were the global pandemic of COVID, the market crash of March 2020, interest rate rises, and particularly the squeeze on landlords, which I predicted in Q4 of 2021, and a few other things. But if you're interested in those, I actually have a playlist on my predictions. I also predicted that Revolut would go down and there'd be issues in the angel investing space. So I like to, predict different things. I think it's quite fun. I timestamp them in my YouTube videos, so I'm very open and you can see what I think. It's all published publicly, so I can be held completely and utterly accountable for my financial logic. I'm not a financial analyst, but I do employ financial and otherwise other logic to be able to make these predictions and to analyze companies. Let me know what you think. Like if you think there's some value here, subscribe, send to friends and family that you think would benefit from this. If anyone's working in the finance industry, I'd love to hear from you. Are any of my skills on track with what people are thinking, or are they off base? Are they valuable, etc., etc. Anyway, remember guys, that knowledge is power, especially what kind of knowledge, and progress is everything. I'll see you guys in the next upcoming video. Take care.